Hello again. Today we are going to cover chapter 15, managing working capital. So just to remind you that finance is divided over three fundamental areas. Okay, so one of them is financial institutions and markets. So we covered at the beginning chapters of this course. Okay, the second one was investment part. So we did it investing in financial markets. The previous chapters, okay, the recent chapters were under the umbrella of investment. So now we are going to the final portion of finance, which is corporate finance. The corporate finance basically in this book, or overall actually, covers managing working capital, capital budgeting, and capital structure. Okay, so now we are covering managing working capitals, and the upcoming chapters we cover capital structure and capital budgeting. Okay, so we learn what we are talking about. Okay, so whenever we talk about working capital management or managing working capital, so working capital in a company is related to the short-term activities. Okay, basically less than 1 year activity. So whenever you hear working capital, so it means they are talking about working, so activities of the company within less than 1 year. Okay, so those are treated with current assets and current liabilities. Okay, with less than 1 year, not long-term assets and liabilities. Okay, it's very crucial for any company to manage these activities, otherwise they may face bankruptcy actually. Okay, so rational managers would decide about how much to invest in the working capital or current assets, okay, and how to finance them when we need some cash, some liquid assets for our operations, very urgent. Okay, so from where we get the cheapest cash to finance this activity. Okay, so very crucial for any company. However, this working capital strategy can be different from a company to another company based on their industry actually. Let's say from a sector or industry to another one. Okay, so the current asset, the amount of current asset in the balance sheet can be substantially different. Here is some examples over here. So here is current assets as a portion of total asset percentage. Okay, so over these years. Okay, so let's see McDonald's. They have less than 20% current asset. So mostly the asset is long-term asset. Okay, it means they don't need that much asset to manage their operation. So that can be because they are dealing with daily customers and they can earn enough cash every month, and they are not selling on credit, they just sell on cash, no credit. Can you go to McDonald's and eat a Big Mac, then say I'll pay next month? No. The same is for Walmart, hypermarket, retail, okay? Look, they obtain a steady level of current asset, okay? But what about Google and technology companies? Microsoft over here we have, and this has been coming down over here, okay? Software and technology companies. So they have high proportion of the asset to be current asset. So it means they need that asset to avoid risk of bankruptcy and to manage their daily operations, short-term operations efficiently. Okay? So what's included in working capital? So what are the activities under the umbrella of working capital? What are the activities? Here we have operation cycle, okay? When we talk about working capital management, so we talk about this cycle or cash conversion cycle. Okay, I'll come to that in the upcoming slides, but just focus with me with the operation one. Basically the company got cash, okay? Got cash. And then they want to produce something to sell. So they have to get the raw materials. They have to get the raw materials. So they receive materials and they pay for it, okay? And when they receive materials here, it means they are using it, or they are keeping it in the inventory, okay? In the inventory. So they produce it. Again, finished inventory over here. Keep it in the inventory here. Okay? Then they will give an extraordinary effort to sell what they produced. Finished goods. They are selling it. Okay? So they may sell for cash or on credit. The customers pay for it later on. Okay? So if cash directly goes to cash, we have no problem with that. But if on credit, the customers pay later, and there will be an account for it, which is so-called account receivables. Okay? And then how long it takes to collect the payments of goods and services from the customers. Collection period. And then when you get it back, so you get it in cash, of course. Enters the cash again. Okay? So, talking about the operating cycle, basically we concern with inventory and receivables. Okay? Inventory and receivables. Okay? However, if we concern about the payables, okay, so here we consider that we pay for all materials from the suppliers in cash, but if we pay it again on credit, pay it later, so there will be another account over here. I would call it accounts payables. Okay, there will be another account, payables over here. Okay, account payable. So how this works, again, but when we include the account payables in our operating cycle, so we will go to cash conversion cycle. Okay, so cash conversion cycle is the average account receivables, inventory periods, and minus account payable. Okay, so if I ask you to find operating cycle, you will include only account receivables and inventory period. But if I say find cash conversion cycle, we mean this: you deduct account payable from operating cycle. What do we mean by cash conversion cycle? The time it takes for a firm to pay the suppliers for inventory and collect from the customers. Okay, here is it. Here is it. Now we receive the raw materials from the suppliers, we put them to the inventory over here, and then finish the goods to sell them. We sell them, and we have account receivables and also cash. So this is a time frame for them. Okay, so this is so-called operating cycle. Okay, operating cycle, the whole process. But if we deduct account payables here, so we will have cash conversion cycle. Okay, CCC, cash conversion cycle. So this is basically what it's meant by working capital management, managing working capital in the company. So we are dealing within less than 1 year. Okay, what if we get our supplies from the suppliers, we finish all good, okay, sell them on receivable, but we don't receive the payments on time, so we are not able to pay for the suppliers on time, so there we will be in trouble. That's why it's very important to have sufficient cash or equivalent to liquidate for the needs of that period. Okay, now so determine the length of the operating cycle and cash conversion cycle. So if we want to determine how long it takes, how many days supposed to take the inventory life cycle, inventory period, or account receivable period, or the average payment period. So it's very, very important to specify how many days this should take. Okay, or how many days has been taken from the past periods. Okay, so how it's supposed to be? Is it good to have a shorter period or longer period for each of these accounts or activities? Okay, so now inventory period tells us the time between when the raw material received and the corresponding finished finished goods were sold. Okay, time from receiving the raw materials, producing the goods, and selling them. Okay, and selling them. The company can be not manufacturing, so they get the ready good to the inventory. So the time between getting the ready good to the inventory and selling them. Okay, so inventory period, when the good is out from your inventory, then the inventory period will be finished. What about account receivable periods? So when you sell, as I said, on cash, you got no problem, okay? But when you sell them on credit, how long it takes to receive the payment, to receive the cash from the buyer or customer, okay? So account receivable period measures that one, okay? And also how long it takes on us to pay to the suppliers from the day that the raw material received and to the day that we pay to the suppliers. It's very important to know, like, okay, regarding the inventory period, it's better for the company to shorten this one. So the shorter the period, the better for the company, the more efficient is the managers, okay? The same for account receivable. The shorter the period, it means, for example, we are collecting the payments of our goods that have been sold within 20 days rather than 30 days. Definitely 20 days is better. But if we are able to postpone a little bit the payments to the suppliers, average payment period, so that would be much better for the company. Instead of paying to the suppliers within 30 days, let's pay to them within 45 days. So we keep the cash in our hand, we can use it and benefit from it. Okay, many of research and empirical papers has proven this phenomena. Okay, so how do we measure it? Okay, here is the financial statement of a company over here. Revenue, cost of goods sold, account receivables, inventory, account payables. So basically those are the numbers we are looking for when we want to calculate cash conversion cycle, working capital management, okay? Cash conversion cycle. Now, we start with operating cycle, which means inventory conversion period, average collection period. These two, okay? This is the formula. This is the formula that to be used to find cash conversion cycle, so inventory conversion period. Okay? We talked about inventory period, inventory conversion period over here. Inventory divided by cost of goods sold divided by 365 days. So this is average per day cost of goods sold, okay? Here we are dealing with days. How long time, how many days it took for one good to receive from inventory, produce, and then sold. Okay? On average, in our given example for this company, Walgreens company, we can see that it took 41.39 days. on average. Now, what about average collection period? How many days it took for any of the goods that sold to receive, to collect the payments from the buyer? Okay, how we calculate it? This time we have net sales divided by 365. Okay, over here, this is the formula we calculated. So we see that Walgreens company has 24.17 days average collection period per each good that has been sold. Now, so having these two over here, we can calculate operating cycle. Okay, inventory conversion period plus average collection period. So both will be 65.50 days on average. Okay, so it means that from the day that receive the raw materials, production, selling the good, count receivables, collecting the money, for each product takes 65.56 days. But if we want to calculate cash conversion cycle, so definitely we need average payment period as well. This is a formula. Also it is 48.12. Okay, so cash conversion cycle equals operating cycle minus average payment period. So we know that operating cycle was 65.56 days and we have 48.12 days average payment period. So we deduct this from this and then we have 17.44 days. So for each supplies it takes 17 point, no sorry, so the overall receiving the supplies, raw materials, and then producing the goods, selling it, collecting it to cash with deduction of the suppliers, the payments to suppliers. Okay, we deduct that one. It takes 17.5 days. Okay, so that's how we calculate the cash conversion cycle and operating cycle, which are definitely very, very important and would be asked in the exam. Now, so as we said, the working capital management is very, very important, okay, in order to avoid bankruptcy or any unexpected need for cash. Now, so how the companies planning to avoid that? Okay, it's particularly important. So they will estimate their cash budget. So they will estimate their cash budget and deduct this cash budget based on the forecasted spending and income. So basically overall there are cash outflows and cash inflows. They predict the cash outflows and inflows over the upcoming periods. Okay, so they predict that according to that one and using the historical data of the company, so they know how to estimate for example, how much cash would be needed from the would be needed for the period of February. What about August, November, December? So they know the overall estimated expected cash flows, cash inflows and outflows over those months. So accordingly, they deduct cash for it. Okay, so they know, for example, so they have a limited cash, so cash budget for that. They have the upcoming month, for example, can be a surplus, so they have exceed cash, they have excess cash on that one. So if the excess cash is there, they plan to how to invest this excess cash. Okay, they have to benefit out of it, benefit from it. So if they expect to be deficit, so they should consider to have a reserve of cash for that deficit to be financed. Okay, or if it is sufficient, so no worries. Okay, so according to all these estimations, they should have minimum desired cash balance over the period, typically the period of 1 year. So this minimum cash that would be dedicated for this period would definitely or almost saves the company from any risk of working capital. Okay, so like this company, okay, this is the East North Manufacturing Company, and these are the sales of it. Okay, 3 years are here, 2014, 15 and 16. Look at this. So all the years we have a same trend, almost same trend of sales. Okay, so they know how much would be the income or in cash flow. Okay, so there are two main factors, sales and customer payment pattern. Okay, so this should be accompanied by the collection of the account receivables. Okay, so given this example, look at this. So the sale is given here, so 50% the collection of the previous month. It means that in December 50% of November's sales will be collected. Okay, so 50% of 2 months past of collection. Here we have, for example, January, so 50% of previous months collection is here, and 50% of 2 months before is here. Okay, 50% of November's one is here. So the both total receipt is 90,000, and it goes in this way. So that's how the companies can forecast the income, cash inflow. Okay, cash inflow. It is the same for cash outflow as well. Okay, so this is the sales, okay, inflows. But what about the suppliers? Payments of purchase of the second previous month. Okay, so here they pay for this month. Here they pay February, they pay for December in this account. Okay, they have salaries to pay, rent to pay, interest on debt to pay. Dividends possible to pay. It's here because it will be 3 months, every 3 months typically, and there will be a tax as well. Every 3 months they pay taxes, and even also yearly based. Also capital expenditures. Okay, so they have their fixed or estimated total cash payments, so they can estimate that one. Okay, they can estimate that one. So for a company here, for example here, then they realized that the minimum, or they issued the minimum desired cash balance to be $25,000. How they are going to use it here? For example, in January, the cash outflows are substantially less than cash inflows. So that will be the net cash flow over here, positive 30,000. But in February it's just different. Okay, now, so how they balance for it? We have only 30,000 over here. Okay, the minimum desired cash balance or cash budget is 25,000. So we have this one as well. So this plus this one will be 55,000. So we have to only give a effort to rise $7,000 over here, not more. Okay. So we don't have any left for March. Again, in March we should go back to the 25,000 budget for each month that has been dedicated. So we paid 9,000 for this deficit over here. Still we got $16,000 in our budget. What about April? In April, $5,000 extra we have. Okay, so the sum, we add this $5,000 to our monthly budget, 25,000, and then that will be 30,000 in our reserve. Okay, so that's how it works. That's how company planning for their cash budgets. So therefore, the management of current assets, liquid assets, or cash or equivalent assets is very, very important. So they should know, they should be able to raise cash to liquidate some assets, and they should know how to invest in the current assets, in what cost will be the current assets, and to regulate regulate and organize the credit policy, actually also inventory. Okay, so overall you have all these different accounts and many others within the framework of current assets. It's very important to balance them in a way that you won't be in need of cash. Okay, also having too much cash is harming the company, because excess cash, because of the time value of money. So they could have been invested somewhere and generate some profit. Okay, so so balancing between these assets is very important. Okay, that shows us the efficiency of the management within this framework. Okay, so what are the typical types of items of current asset, we have them here. Cash, we know what's cash. Marketable securities, those securities like treasury bill, for example, federal funds, and all these other items over here are marketable securities. Okay, so we have them here. So we can convert these, we can liquidate these, we can convert it to cash with a very, very small time and losses. Even some of them can make some profit. Okay, so how much to keep in our portfolio from this bond, from that one, from this? Okay, very, very crucial. Now, the management of receivables is very important. So there should be a target for this as well. There should be a target for this. Okay? The financial manager must balance the advantage of an increase in sale from more customers against the cost of financing high receivable investment and increased collection costs. So if we say, okay, we facilitate, okay, we have a good credit and you can buy our products on credit, okay, and it's not that much different from the cash payment when you pay it in cash. So we can increase our sale. But what about the cost of collecting that one? What about the guarantee that they will be paid on time? At what cost you are able to collect them? Okay? So these are very, very crucial for the management. So you set up a target for your account receivable period, and the target should be obtained. So it can be less than your target but not exceed of your target. In this example over here, we have a firm might sell on credit terms on net 60 days and have net sales of 720k and an account receivable balance of 150. For this firm, the average collection period is as following: 150 account receivable, the total sale, divided by this 76. You see, the account receivable is larger than the expected one, the targeted limit. Okay, so they should lower this account in order to be on the target. For example, if they sell an iPhone for cash for $1,000 but on credit $1,050, if it's not on target, that may cost $70 to collect that account receivable for each iPhone. So they lose $70, which is insane. Okay, the same for inventory management. So managing these accounts, just keep in mind that managing these accounts will be varied from an industry to another one, a company to another one, based on the industry. Just as we saw how different is the proportion of current asset to total asset. Okay, so this is another company to how to manage inventory. Let's assume firm's cost of goods sold is 600k and it has inventory on hand 100,000. Recall the inventory turnover. Okay, this is the turnover. Over here it's 6 times if the firm is able to increase inventory turnover to say 8 times, then the investment in inventory can be reduced $75,000. However, if a tight inventory policy imposed lost sales due to stock outs and results in lost profits and more than offsets financing or cost saving. So whether they have an expansionary policy or tight inventory policy. So the financial manager must balance possible savings against potential added cost when managing investment in inventories. Okay. Yeah, so that was the end of this chapter, and here are the reviewed questions. You can find them within this video, or if you refer to the slides, definitely you will be finding them. Also, we have these two problems. I'll solve one of them and you can just easily solve the other one using the same method. Okay, and now okay, if you face such a problem and you see many items over here, so this is the balance sheet and this is the income statement, you are not necessarily required to include all these items in your calculation. You just pick whatever you want. Okay, you just pick whatever you want. So these are given and the question is asking us to calculate the operating cycle and cash conversion cycle. Okay, so here I have written the formulas. First we go for operating cycle equals the inventory collection period conversion period, plus account receivable period. Okay, now account receivable period is given here. Let's start with the inventory conversion period. Inventory conversion period is given there, equals to, we have here inventory. Okay, inventory. So I'll calculate for 2016 over here. 450,000 divided by cost of goods sold is here. Okay, 780,000 divided by 365 days, which equals to 210.5 days. What about account receivable period? Equals to, account receivables are here, 200,000 divided by, what we got here is net sale $1.3 million. Okay, divided by 365 days a year, which equals to, so this equals to 51, almost 51 days. Okay, so now operating cycle equals to 210.5 plus 51 days, which equals to 260.5 days. What about, okay, what about cash conversion cycle? Equals to operating minus account payable period. Okay, so we need to find account payable period, which equals to account payables 130,000 divided by cost of goods sold divided by 365 days, which equals to almost 61 days. Okay, so your calculation may be very slightly different from mine because I round the numbers. Okay, now finishing our answer over here, cash conversion cycle equals to 260.5 minus 61, which equals to 199.5 days. Okay, so you can go at the question asking us, you can go over the same calculation over here for 2017 using the same method I did, okay, and see the difference between them, whether those have been changed or not. Also, we have a question over here: inventories, account receivables, and the other stuff, cost of goods sold, is given here as a percentage of sale. Okay, so you can calculate them and we can discuss it. You give some effort for this because these are particularly important for your exam as well. So you give some effort and try to solve them, and if you have any problem with that, just let me know and we can discuss it in the online session or hopefully later on the campus. Thanks for your attention. That was all for today.